Hello everyone, welcome back. So in this video, we are going to discuss about the order flow charts, also known as footprint charts, which has been introduced by this market delta in 2003. These order flow charts are relatively very new to the trading community. First of all, why order flow charts? Why a trader need to use order flow charts when it comes to other many methods, hundreds of methods, candlesticks, price action trading, or whatever. So these are the most common questions which are asked by these traders who first time come to know about these order flow charts. Are these order flow charts better than any normal candlesticks or price action trading? Or these OF charts or order flow charts complex to understand? So the moment they see the numbers on a candlestick, it looks like it's more complex. So we need to address all these questions. Does institutional traders use this? What is the accuracy of these order flow charts? How much I can earn using these order flow charts? So these are the common questions. Let's address these questions very brief. When it comes to the first question, are these order flow charts better than normal candlesticks and price action trading? So what do you see in a normal candlestick? So in a normal candlestick, you don't have any kind of numbers and all, right? So what do you see is basically this kind of candle, this kind of candle. So in this candle, what do you see? This is a bearish candle. There was a wick on the top which indicated some selling pressure is there, and the prices have closed below the opening, right? And there is some wick on the downside which indicates some buying pressure have come lately. So apart from that, you don't know much in this normal candles. Whoever use normal candlesticks or price action trading, what else they use? They go for double bottom. So the prices makes double bottom, and if the prices breaks the previous high, then there is a likelihood the prices might go up, or if the prices breaks downside, the likelihood the prices might go down, right? So these things is what they use, right? Or cup and handle, this itself is a double top, or some other patterns. Along with these normal candlesticks, what else you can use? There will be a volume in a normal chart, or an indicator, right? Indicator, most of the time it will be a lagging indicator. Any indicator, uh, it only any indicator, it only tells you what is happening after the price has formed. Now when it comes to order flow charts, this is what you see. So what you are looking at is multiple numbers. So these numbers are nothing but the real time orders that are being executed. So a buyer came in here, 2.9k buyer, which has been supplied by some seller. So that buyer couldn't hold the level, so the prices came down. So if you look at around the same level in Bank Nifty, on the previous day we have the same buyer who bought, but the same seller has sold it to the buyer. So again the prices came down. So here what you are learning is the live executed order, which are giving you the in-depth X-ray vision of the candle, why the candle is formed. And this delta tells you that there is a strong buying, but despite of that strong buying, the prices have closed at the lows, which is indicating buyers are not able to hold these levels at all. In the hands of right trader, these order flow charts are very powerful, and many people, the moment they see, look at these numbers, they automatically, it creates a fear that it's going to be a complex subject at all. So here, basically, you are not doing any kind of addition, subtraction, or multiplication, anything. So basically, what you just need to see where to look for. You just need to understand where to look for and what to look for. So that is the subject, and everything what we do is revolves around these two. Now we have another question: does institutional traders use this? So who are institutional traders? You have to first define who are institutional traders. So institutional traders, if you mean by these are the people who have huge amounts of money, let's say 100 crore, 200 crore, 300 crores rupees. Now, why do they want to use this? See, this 2.9k, let's say this order has been placed by an institutional trader. Now, why do he needs, when he is placing a 2.9k order, does he need this order flow? Because he himself is placing the order. Unless he places a order, this order won't be visible on this chart. So there is no use for him basically. So they look for macroeconomic things and all. So when it comes to institutional traders, these are people who have thousands, hundreds of crores. So those people, I don't think they have any use for this order flow charts. Now, as a retail trader, you will understand these footprint charts. Why these order flow charts are called as footprint charts? The reason is this. You will understand the footprints of these institutional traders. So they may not use or may use whatever it is. Mostly they don't use, but you are looking at the footprint charts. There is a big trader basically. So these orders are placed by some other traders, right? So at what level, which order, which big trader is trading? By understanding this, you will, as a retail trader or a small trader, you will try to you will try to come to you will try to come to a conclusion that where the prices are headed. Next question will be, what is the accuracy of this order flow chart? So when it comes to accuracy of these order flow charts and how much I can earn using these charts and all, it's always a subjective answer. So not only with these charts, it's the same thing with any other chart. Let's say if I teach a single strategy to 100 people, each and every person will have a different outcome. The reason is not because of the strategy, but because of their own emotional balance, emotional levels, the psychology, discipline, risk management, everything. So if you have the right risk management, the right discipline and all, these are highly, highly, highly powerful. If you have that experience and all, these are highly powerful. Nothing can beat this. Right? And when it comes to accuracy, so how do you measure? There are almost 10 concepts, nearly 10 to 15 concepts in this order flow charts. How do you measure a system when there are 10 to 15 concepts? Each and every concept you have to measure. Now again, when you measure these at different market conditions. So let's say the market is in sideway market. Let's say the sideway market. Again, one concept, one strategy might work in a different way. When the market is in highly volatile, the strategy might work in a different way. Or if the market is with high volumes, it might work in a different way. If the market is in highly momentum market, it might work in a different way. So each and every condition depends. So basically, all these 10 concepts using other 5 to 6 market factors, measuring the accuracy, it's not really possible. There might be people who might be saying 100%, 200%, 100%, it was 99%, 90% work. So it's all baseless talk. So they just want you to throw something, and for that they try to say all these things. So other than that, you can't really measure any system. The reason is you need to take a sufficient sample size of at least minimum 300 days, and then sideway market 100, in that sideway uptrend market 100, and then downtrend market 100. In that you have to subdivide all the concepts, which concept is how it is working. So you need to measure in that way. Unless that happens, it's not that easy to measure the accuracy of any system, not only this order flow system or any system. My suggestion would be, have a commitment for, if you really want to become good at this, have a commitment for at least 6 months to 1 year, and the way you look at markets will be totally different from what you have seen 1 year before looking at these order flow charts and market profile. Market profile, again, it's a deeper subject to understand the market structure and all. So if you have that commitment, you will become really good at it at the end of 6 months or 1 year, 2 years, something like that. Without that, just depending on a single strategy, 5 minute, 10 minute YouTube strategy, it doesn't work. One day might work, 2 days it might work. When the market condition changes, everything changes, and you will again end up losing the money. This is my saying. So this is with the questions, guys. So now we are going into topics. So what are the topics we are going to discuss in this video? So almost everything we will be discussing. As far as I know about order flow, these are the things: how to read order flow charts, what is passive and aggressive buying both, identifying buyer and seller interest, delta versus cumulative delta difference, divergences of this delta and cumulative delta, caught high, caught low, all these three things. Liquidity zones, volume clusters, imbalances, unfinished business, finished business, single trade, stop loss hunting, how to identify. So stop loss hunting, trapped buyers, sellers, iceberg orders. So these are few concepts. So you can understand how many concepts are there. So this is one thing. This is 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, almost 10 to 15 concepts are there. So when such concepts are there, asking for accuracy and all, these are all baseless. Have a commitment and get some guidance from a good person, and then you work it out, paper trade, how it is working, understand each and every conditions, and then look for yours, how it works. So let's start now. Let's start with how to read a order flow chart and what is the difference between the passive and aggressive trader. I hope you understand what is this two candles. One is a bullish candle, one is bearish candle. So if you understand the structure of this bearish and bullish candles, what do you understand? Basically, the prices opened at some lows and then the prices were sent lower by sellers, and then buyers came immediately pushing the prices higher to the higher highs, and then at the highs some sellers came in and closed the prices above the opening, which indicates since the body itself is closing above the higher above the opening, since the body itself is closing above the opening, it's a bullish candle, and there is some kind of selling pressure at the high and there is some kind of buying pressure when there is a lower low. So same thing, exactly opposite. The prices were opened in this bearish candle at the highs, and then the prices had made higher high, and then sellers came in and pushed the prices all the way to the lower low, and then buyers came in, closed the prices a little higher than the low point. So basically here the closing price itself is lower than the opening price. So this is how the bullish candle and bearish candle will be there. Apart from that, you don't understand anything in this. So let's see how does an order flow candle look like. This is how an order flow candle looks like, or a delta candle looks like. So what is order flow candle basically here? This is how it looks like. So to understand this order flow candle, let me give you an example how to read these orders, why these orders are being printed this way. So when I ask why the prices moves in the market, the most common answer will be the buyers. Whenever the buyers are higher than the sellers, the price moves up. Whenever the sellers are higher than the buyers, the price moves up. So this is only a half side of the story. Now the answer is not necessarily the whole truth. So what happens here? This is the DOM. This is the DOM. DOM means depth of market, so which is visible with the 5 best quotes or 20 best quotes in zeros on down. Best quotes will be there. So this is nothing but in this, what do you see is the limit orders. So I have some extra stock and I want to sell it at 106 rupees. I have 17 some quantity whatever which I want to sell it at 107, 106 rupees. And some other buyer, some other seller wants to sell it 107, 108, 109, 110, and so forth. So far the prices. So always remember this: sellers want to sell always at higher prices, right? Buyers want to sell at lower prices, so the lower prices. So the best buyer who is ready to buy is at 104. This is the LTP, last traded price, 105, and this is 105. So the total quantity here is 410 quantity, here 368 quantity. Now these are limit orders. Limit orders means you are limiting your prices where the prices has to get executed, right? So when you place these orders, your order doesn't necessarily have to get executed. Reason, unless the prices comes down to this point, it won't get executed. Now why the prices will get executed? It's because of if someone places either a market order or a opposite limit order. Means if in a market order, what happens? The moment I place a market order, there won't be any specifying of price in market order. So what is market order? In a market order, you don't specify a price. The moment you place a market order, sell order, I mean, it will immediately go and execute at 104. If you, let's say, suppose you place a 200 quantity of market order, sell order, immediately the prices goes and comes down, eating away all the orders here, until your total 200 quantity gets filled. So it will come up to this point, somewhere around this point, and settle. So the last LTP will be shown as 101. So in a highly liquid market, this process will be happening very quickly. You don't really understand what is happening in seconds of time. So this is how the prices moves at. So the moment I place a market buy order, the prices goes eating away all the limit orders. So either this market order has to be happen like this, or a limit order specifying 104 rupees has to be placed. So I want to sell at a sell stock at 104 rupees. The moment I place limit order with a specified price of 104 rupees, 50 quantity, immediately it will go and execute at 20. So in that 50, 20 is gone. Still 30 will be pending, which will be shown below this. So below 106, 104 will come, and above that also some seller definitely will come. Right? So this is how the orders gets executed. This is what happens in the order flow candle. So suppose once the order gets executed on 106, so it gets printed here, right? 106 and 107 and 108, 109, 110, right? And market orders gets executed here. 105, 104, 103, 102 like this. So you are getting a candlestick space. So by understanding the right side orders and the left side orders. So what is right side orders and what is left side orders? So right side orders are nothing but the aggressive orders getting executed on the sell side, sell limit prices, right? On left side is nothing but the aggressive sell orders getting executed on the buy limit. So that is what this means. So in this, when someone says because high buy orders are there, the prices moved up, it's only a half truth, because you need to specify that there should be more aggressive orders than more aggressive sellers. Only then the prices moves us. So the prices will keep on going up until there are more aggressive orders. So what are aggressive orders? Again, it's just nothing but the market order. So when more aggressive sell orders are there, the prices keeps going down until there is at least one more aggressive seller than the aggressive buyer. So this is how the prices continuously happen. Right? This generally in low liquid stocks you can really see this. So two takeaways is market order is also known as aggressive order, right? Whether it could be market sell order or market buy. Passive order is also known as limit order, right? Limit order means he is specifying the prices. So don't get confused in between. So I'll be using these two terms. So you need to remember all these things all the way. So what is delta here? So delta is nothing but the net difference between buyer and seller, nothing else. So what does it mean? Look at it. What is the net difference here? So this before going into this, so we try to understand the order flow in terms of generally aggressive orders. Why? Because these people are moving the markets. So we try to understand in terms of the aggressive orders mainly, but not necessarily. There are few things where we understand in terms of the limit orders also. So slowly as we go into the subject, you will get to understand what it is. So in this case, so for now, just understand right side or aggressive orders, aggressive buyers, left side or aggressive sellers for time being. So here when I say aggressive buy orders, it means there are limit sellers also, right? For the time being, just go with the right side is nothing but aggressive buy orders, left side is nothing but aggressive sellers. So what is delta is nothing but the net difference between this aggressive buyer and aggressive. So how much more buyers are there? 2 buyers. In this case, 60 buyers, 60 extra buyers. In this case, 250. So at every price level, this is the delta. So what happens in a normal chart? Again, if you add all the right side and all the left side, you will come to a conclusion that you will get a figure, whatever the number you add all this at the lower top, which exactly is delta 1.3. So whatever the delta you are looking at, this delta is nothing but right side and left side, add everything, and whatever the net difference is there, this is this. So next, going into the next topic, we'll understand how to identify a buyer and seller interest and what is delta and cumulative delta. To understand buyer and seller interest, so in a uptrend, so for the sake of making you understand better, in a uptrend, so to understand a buyer and seller interest, it's very essential to understand. So this doesn't necessarily have to be 100%, but most of the time when buyers and sellers are interested around above the candle highs, around the candle highs, there will be both side passive and aggressive buyers, both sides. If only at the aggressive buyer side more amount of volumes is there, it means that the price is moving up mainly because of aggressive buyers, maybe in the cases of short covering something. So if also limit buyers are more or less equal to the aggressive buyers, it means that both people are coming, so the uptrend might sustain for long amount of time. So how to understand the buyer and seller interest in a candle? So this is the 9:15 candle on Wednesday 27th September. So what do you see here? What do you see here? Basically, it's clearly visible that more amount of aggressive sellers are there on the lower side, and also remember here good amount of passive sellers are also. So as I said previously, when both aggressive and passive sellers are volumes are high, then the likelihood the prices will go down increases. So if the same volumes on the opposite side at the tops are high, the prices will go up. So here look at it, the volumes are more or less equal at the lower side, and at the top there are no volumes. Now sometimes there could be volumes here and then here also. Sometimes it also happens. So this looking at buyer and seller interest, it's not a rule, it's more like a guideline when you continuously track. So 1.5k 428, not a good seller, and then look at this. What do you see? More amount of aggressive sellers. On right side there is no sellers. So we understood this is aggressive buyer and also a passive seller. So here passive sellers are not there. Only aggressive sellers are there, most quantity. So here 558, 128, 283 is there, but the orders itself or not total orders itself is not matching with the left. More or less it has to match. That's what I said. So mainly look at the lower points here, 3 to 4 lines. So it is not matched. So it's a clean candle which indicated prices have been taken control by the sellers, but almost immediately the prices moved down because it's because of aggressive. Right? So look at here, more volumes are there, and look at the lower side. No volumes. Right? Good volumes on the right side in a candle. So which indicated not much of aggressive selling is coming at the close, which means maybe the trader, maybe sellers are being exhausted. You need to be very, very careful in this kind of scenario. So next, what happened immediately? The prices made a lower low. There was a small candle, a green candle, and then the prices made a lower low. And look at again when the prices came down. When prices made lower low, there is not much of volumes except the last time. And then at the top, This is the green candle. In a bullish candle, we discussed that at the top both side volumes has to. So here both people are coming, both aggressive buyers and also passive buyers. So if sometimes happens, the here also more volume will be there, here also volume will be there, and then the prices will go up. Sometimes this also happens. In those cases, you need to understand what might have happened. Initially, the sellers have sold it and hold it for some time, and then sellers ran out of whatever the stocks they had selling quantity, and then at some point of time buyers took control, and then the prices spent at the top. So in that case also the prices might move. So here there is clearly buyer interest at the tops, and look at this here. There is no buyer interest at the tops, two lines. Here it's there. But at the same time, you also need to understand where the price is closing, how the price is closing. So in order flow, it is very important to understand the cause and effect. So here buyers are coming in at the tops, indicating good buying is there. Right? So the prices moved up and it closed at the top. And then look at the top, there is not much of volume in the last two lines. And then there was a pullback. And then again, the prices went and closed at the highs. Right? So look at here, not good volumes. Just above the half back of the candle, there is good volumes. And there was a pullback. And there was a pullback. Again, when the prices are coming down, look at how the volumes are. So this is only a concept. So you don't need to depend on this totally. So this is to understand sometimes what happens, the prices will be moving up. So to understand the momentum in the market, you just keep on looking at it. So just because there is no volumes left side, it doesn't necessarily have to immediately turn around. There could be a consolidation, and then the prices might go up, and sometimes yes, there might be a turnaround, or sometimes what happens, slowly the prices will spend here, and then volumes build up on the left side. Right? So all these scenarios will be there, but this is how a candle looks like. So look at this again. The prices closed here above the opening, and then what happened? Not much of volumes at the top. Not much of volumes, not very strong. Volumes is there, not very strong. Since the price is closed below the volume here, COT we call it, which we will be discussing in the next coming video. Immediately there was a pullback, and then look at it. Good volumes are there, and then consolidation, not good amount of volume. So there is a wick here, not good volume, and then not good volume. And look at it. Here again, volume started. On lower side, not good volume. So in this case, again, look at it. Volumes are drying up. It's not completely dried, but volumes are drying up, indicating maybe the trend itself is coming. The momentum in the market might be losing. Right? So look at it here. Good volumes is there. So the prices again immediately there was good amount of volume on the right side, on left side nothing. This indicated that the momentum is not there, and prices closed at the inside the previous candle, and then the prices we have it down. So this is what happened. So this is how you track the continuity, the momentum in the market. Right? Now we are going into delta and cumulative delta. So what is delta? Again, this I have given a touch up in the initial stages. So what is delta is nothing but it is the net difference between buyer and seller. So again, when I say buyer and seller, delta is always calculated by taking view of aggressiveness, not the limit. So here, right side here we discussed that right side is nothing but the aggressive buyer and left side is aggressive seller. So what we do, we add all this left and right sides, and we see how much difference is there. Delta here is 504, so there are more sellers, 504 sellers than the buyers. So it says that sellers are little aggressive. Now in the next candle again, 306 buyers are high, 104 sellers. So it's a bullish candle. We have a negative delta indicating sellers are high. So here to understand this delta, you need to understand don't you should not depend solely based on delta. So you need to see cause and effect. So what is cause and effect? So you can take this delta as delta as the cause and how the candle is closing around which reference. So the when you combine both these things, it becomes more useful. So along with other COT concepts, imbalance and all, it becomes much easier to take a trading intraday. So here, let's see. In a uptrend, what should happen generally? This is a basic idea. It doesn't necessarily have to be true. So in a uptrend, what should happen generally? Volumes has to increase. That is how a healthy uptrend has to be there. In a downtrend, there should be negative delta continuously increase. So what happened? Look at this. Here 63 delta, which is good. 62, not much. Negative delta. So 220. 405 negative delta, 2K, 2.5. So in 5 minutes and 15 minutes, you will get much better clarity if you look at this. On 30 minutes, the time frame will be too high. So delta solely it may not work. So what happened here? Look at how the candle is closing here. So despite of small delta, almost not much of aggressiveness, the prices have closed above the almost at the highs. Here also it's good. It's closing around the highs. It's not exactly high. Here also it exactly closed with the high. But here look at it, 2.5K, 3K delta. So it's a very strong delta. But despite of this, despite of strong delta, the prices are closing at the lows. So this indicates maybe buyers are losing their control. So what happens when these buyers doesn't have the capacity to push the prices much higher side? So at some point of time they unwind the positions. So which happened exactly on the next. So here again they tried. There was a sideways market, and when these people, whoever have entered here, all these aggressive people, when they exited, look at how strongly the downtrend has happened. In an uptrend, generally idea is delta has to be increasing. So again, when the delta is decreasing, it doesn't mean anything, but it says that slowly buyers are decreasing. So momentum might be decreasing. It doesn't necessarily immediately mean there will be a turnaround and a downtrend and all. So delta, this is the delta. So sometimes what happens is there is something called divergence. So which we are going to discuss here. So this delta and cumulative delta, there will be divergence. So what is divergence? Here we are going to discuss. So here, so here you can see a clear case of delta divergence. So this is negative delta is there 1.3K, which is a very strong one. Despite of that, the prices have closed here. So what you do, if you want to take a trade, you take when the previous highs is broken. So here the previous highs is broken, and then once high is broken, you can take a trade. Right. So the cause and effect is opposite. The delta is bearish. Right. So bearish divergence is there definitely here, but immediately don't take it. So always wait. So bearish divergence, whenever you see this kind of delta divergence, wait for some time. Most of the time, generally with this kind of delta, heavy delta, whenever it is there, prices goes in the direction of negative delta. So again, if you want to take a trade downside, you take the trade on 3 minutes or 5 minutes when the previous lows is broken. So here, right? Keeping a stop loss just above the breakout. This is with the divergence, delta and delta divergence. So this generally happens on a day-to-day basis. But you need to understand, what you need to understand here is cause and effect. Without cause and effect and your entry and exit points, you can't totally depend on this delta. Because there is a green delta, you can't buy. Because there is a negative delta, you can't sell. So that's not how it works. So now we are going into cumulative delta. So look at this cumulative delta. So what is cumulative delta? So cumulative delta is nothing but the accumulated delta from morning. So this is the September 15th. So what happened? 844 negative delta is there. Green candle. It's a bearish divergence. The bearish divergence, the prices went down, and because of these imbalances, trade imbalances, the prices again went up. So that's a different thing. So here what happened, if you look at, there is a bearish divergence at 915 and from next to 192. So what happens in cumulative delta? This 192 will be added to 844. So it means that 844 minus 192, because these are buyers, we are going into the positive delta. So when you add this, look at 651, right? And then again the positive delta, again it has been added 160. And finally, when this 210 has been added, 160 plus 210, it will be 49. Okay? So that's how this delta will be accumulated whole day from 9:15 to 3:30. Even you can go on to 5 minutes, it's the same thing. If you go into 1 minute or 3 minutes also, it's the same. So by understanding whether the cumulative, so it's just like that delta. It's just like delta, but automatically here the delta is being added. So by understanding the delta, you are going to take the trade. So it is giving you much bigger picture about the delta. So what is cumulative divergence? So here we are going to discuss about cumulative divergence. So what happens is cumulative delta also, it has to continuously increase as the price is going up. The prices will be making higher highs and higher lows, but at some point of time cumulative delta starts reducing. So this is a very rare thing, but again it happens during expiries or something like that. So at that point of time you have a clear cumulative delta divergence. So in that cases there is a high chance, it doesn't mean uh, high chance, it doesn't mean that there will be immediate reversal and all. You need to again look for whether the previous low is breaking or not. So here the low has been broken, and then you can take a trade above below this. Look at this nifty chart. What is happening here? Despite the prices making lower lows continuously, delta is increasing. So why this is happening, you need to understand. So that is the reason why you should never ever trust delta itself. If you blindly trust the delta, there is a high chance at some point of time you get stuck. So here why this is happening is, so initially the people are buying, right? Aggressive people are buying initially. So this is let's say 11:15 candle. At 11:15, people are coming in strongly. At some point of time towards the end of the candle, this is the 30 minutes candle. After 15 minutes or 20 minutes, immediately sellers are coming. Maybe only the sellers are keep on buying it to trap buyers and all. Maybe that might be happening. And immediately around after 10-15 minutes, they started selling. So what happens here? The delta will be showing positive. People will think the prices might turn around because there is a bullish divergence. So it won't happen. So here clearly delta divergence is there. Negative delta divergence all the way, but prices came down. So this is a very classic opposite scenario. Delta in positive delta is increasing, but the prices also is decreasing. Look at this case here. So on this day, 28th September, Thursday, what happened? The prices are increasing. It is making continuously higher highs, higher lows. And at the same time, I am taking here 5 minutes chart. So at the same time, delta is also increasing. Significant delta has increased in this area from 489 to 870, 870 to 1.13, 1.76, 1.76 to 3.22. So despite of this heavy cumulative delta, look at prices how it made a lower low. So ideally with this kind of delta increase, it should be making continuously higher highs because the delta itself is positive. So this indicated us there is a divergence in cumulative delta also. So of course this is a This is also a normal delta divergence, but again, I am saying in terms of cumulative delta. So there is a cumulative delta divergence. So something is going to change here. So again, immediately don't take the trade. So wait for on 3 minutes or 5 minutes. Wait for the previous lows to be broken. So here there is a delta divergence. There is a cumulative delta divergence, and once the prices is broken, right, you can take a trade. So this is the previous low. The price is closing below the low. So even on 3 minutes chart, you will observe the same. So it will be like this. The moment the prices closes below this previous low, you can take it. So this is the cumulative delta divergence. So as I said before, don't depend on anything solely. Cumulative delta divergence or normal delta divergence or anything else. There are again 2 to 3 delta divergence here. So you never ever depend solely on one. So try to understand in terms of the overall context of the market. So the context is what made difference between a successful trader and a trader who is losing money continuously. It's not the strategy. So focus on understanding the bigger picture. So now we are going into what is caught high, caught low. So all these three are different subjects. So caught is nothing but the commitment of traders. So what is commitment of traders? It is the area where maximum amount of traders have committed them. Means buying and selling both has. So this cart itself has been derived from there is a exchange, CBOT exchange in USA, which publishes this cart report every week on commodities, mainly on gold and all, where the people are presenting themselves. So in this report, what it tells is basically at what level maximum traders are positioned. So by if the cart itself is increasing, it means that the positivity, the bullishness among the positivity among traders is increasing. So the likelihood the prices going up increases. If the cart itself is decreasing, it means that people are negative. So they are not very positive about the gold. So cart high, cart low, again, this is a difference. So here we are going to look at cart on, cart low, cart high. So what is cart? So in this candle, you will observe. So this is the whole candle. So if you observe, this is the area where the maximum amount of traders have presented. So again, to use this card, don't go on to lower time frames, higher time frames, it works much better, right? So 15 or 30 minutes, it works much better. So this is the area where maximum amount of buyers and sellers are present. So it shows a rectangular structure. So you can see here 592 and 212, 769, 894, 1.125, 87, 269, 289, 256, 309. So if you take all the areas, this 2.2k and 0, this has the highest value. So at the same time here it's this 548 and 1.2. So this is the cart. So how do we understand the cart? So we relate this COT in two types. First thing is how the price is closing relative to the cart. Second thing, how the cart is presenting itself continuously in the previous candles and current candle. Right? So how do we see? So here this tells us the price from here. Price is closing above the cart here, right? When lower low made. So look at here next also the prices came down, but again the prices went up. Now at the same point when the price is making lower lows here, right? Here one lower low attempt has been made. So at the same time here prices is closing above the COT. So this tells us maybe sellers are failing here. This is one thing. Now look at how do you relate it. So the price is closing above the COT, which means that COT itself acts as a good support of the system, at least for some amount of time. So because the prices have closed above the prices went up and then again it came down. That's a different. But again here look at it, the prices closed above the COT, the prices started going. Now how do you understand this COT compared to the previous COTs is whether the total COT itself is raising or not. So look at here. COT is at high, COT made a lower low, COT is lower low, and then again higher high COT, and then so basically here it's in a sideways market, so it is making higher highs, higher lows, lower low, lower highs. So here again the price is making lower low, lower low, lower low, lower high, and again look at this. When the prices previously came, when the prices made a lower lows, this price has closed far away from the COT. So here you need to understand there are many things that is telling you that the prices might go upward. There is a trapped seller here. So we will discuss this what is trapped seller in the next video. So in this next candle, what happened? Along with this COT increase, COT has risen from low to high. Now again, we can say that the prices are still in consolidation zone. We can't really say whether the prices again will come down or not. Now look at this. COT itself has risen all the way from the previous consolidation zone. So again, COT has made a lower low, but it is still above the consolidation. Now for a downtrend, the COT should have maybe once the prices crosses the previous low, then if the COT would have presented here, then we can say the prices might go down. So but still the COT is at the high. Look at how the COT is raising continuously. It nowhere came below the previous lows, right? Continuously it is raising. But look at here, this everything changed. So it made a higher high, and then there was a sudden downtrend. COT has closed below the previous COT and also previous lows, indicating maybe sentiment is changing, right? And then made higher high, made a higher high. But the last COT here itself, it is not higher than the previous high. So this should tell you something. So if this COT would have closed, the candle itself should have closed above this, and then the COT itself is higher high, then you can say the prices might go up, right? But that has not happened here. So suppose if the COT is like this here, so the COT itself is higher high than this, and the candle has closed here. At that point of time, the prices have moved up, but that has not happened here. The COT itself is lower than the previous high, and then again COT lower low, but again in a sideways market. Now look at this here. It has broken here. The COT is here, but the candle has closed below the COT with very good amount of imbalances on the left side, and then the prices started going down. Next COT is also lower low, so the prices started going down. So it's the same process. You need to continuously observe whether the COT is making higher highs, higher lows, or whether the COT is in consolidation. So you need to keep on observing about this COT. It's a very beautiful tool. When you combine this again COT with the delta imbalances, again it's very powerful. We had discussed about order flow COT. We will be discussing caught high, caught low on that. So before going into this order flow, caught high, caught low, so you can join my mentorship program in market profile and order flow. These are a little bit deeper subjects. So in this mentorship program, we'll be going through in-depth order flow and market profile subject, and you will have a complete picture how to use this in your intraday trading. So it takes a little bit of time to become good at it. So it's not that the moment you understand the concept, you will get to know, and from the next day you will start trading. So as you know, trading itself is more of applying it in the live market. So what we'll be going through in this mentorship is that experience. Whatever I have learned, or you will be going through, whatever the issues you will be going through, we'll be discussing and we'll be trying to overcome step by step. So that is what will be happening in this mentorship program. It's a totally one complete year advanced program. So if you are really interested, and if you want to become a good intraday trader, you can contact me on the number which I have attached in the below description of this video. So now we will go into understanding the cart high and cart low. So what is COT again? This is a candle again. So you have multiple areas, volumes, right? So a order flow candle is nothing but a volume profile with volumes on the candle itself. So this is various volumes are there. So here let's say 10 volume is there, here 12, here 30, 30, here again 12, here 10, so on and so forth. So if you take the whole candle, where is the huge amount of volume? It's here, right? When you combine the left and both, this is the area where maximum volume is. This we call it as COT, commitment of traders. This is where the maximum traders have been committed. So based on how the price is closing or the COT where it is, based on that we try to understand where the market might head, where the support and resistance is there. What is cart high, cart low? So traders committed as the prices is making high or lows or new high or new lows. What is cart high? Traders committed from the high to the current price, means below the high. So cart low, traders committed from the low to the current price. Current price, it has to be above the low, right? So we'll understand here. So this is one scenario to understand what is cart low. A point, B point. So let's suppose this is a total 5-minute candle. So before forming this 5-minute candle, this is how the price spent. A point, B point, C point, D point, E point. This is where the prices have closed finally. Now, from this low point, assuming that this is the low, the next there was no, after opening there was no low. From this point to this point, we call it as cart low, right? The whole A, B, C, D, we call it as cart low. So what is cart high? Now this is the highest point, EP, E point is the highest point from the current price. This is the cart high. Now the reason is this is also a cart high. So if you take this as individual thing, right, from this point to this point is a cart high. But since this is the total candle, 5-minute candle, we are not taking this. We are taking from the highest point to this one, current price. So if you split this 5 minutes into 1 minute, then you will see this will be the cart high. You will see cart high here. You will see C from C to D, cart high here. E to F, cart high here, separately. Now, what is happening when the cart high is forming? More amount of sellers are pushing the prices. So when the prices are making high and the prices are coming down, the prices are being pushed by sellers generally, but not necessarily. But generally, when the prices are making lower lows, here it's assumed that the cart high has to be negative. What is happening when the prices are making higher highs? Right? Buyers are buying continuously. So it is assumed that the cart low has to be, as the prices is making higher highs, the cart low has to be positive as much as possible. Right? One more thing you need to remember is, so we discussed this from here, this point to the current price is the cart low. Now this is 5 minutes candle. The 5-minute candle has been over. So in this 5 minutes candle, if you look at in a split wise, from here to here, let's say you are taking 1 minute candle as separately. From here to the current price, let's say the closing is somewhere here. This will be the cart low. So from this to, again, this will be a separate cart low. So like this, it goes on. So let's say the 5 minutes is over, and in the next candle, the prices have opened somewhere here, and straight away the prices went up. So this also becomes a cart low again. separate, right? From this point where the prices have closed, there was another candle, 5 minutes candle, which started and closed somewhere here, suppose. So this will be the total cart low. Here you will see some X figure. So let's say if you combine this two as a 10-minute candle, then you will see the whole from this point to the current price, where the prices have closed here. To make you understand here, I came up with a small calculation where I have taken this first 30 minutes as an example. From Tuesday 17th, I had divided it into 15 minutes. So in 30 minutes, we have 15 minutes and 5 minutes. So with the same thing, I came up with the same number. So just remember this number. Cart low is 7310, 7.31K, which means 7310. So again, cart high is 180, right? This is where cart high is there. So if you go into the next slide, we have 215 minutes. These are 215 minutes. So how do I calculate this? So 4330. The cart low of the first 15 minutes, that is nothing but this one. Where is this? 4330. Right? 4.33K is nothing but 4330. And we have in the next we have a delta of 3K. So to be exact, it's 2.98K. It has been rounded here, right? So 2980. So if you both calculate this number, we get 7310, which is exactly the cart low of the whole 30 minutes. And we also have here 5 minutes. So this is what 5 minutes. So up to this, it has formed the first whatever we have seen in the first slide, 30 minutes. So all these 6 candles forms the 30 minutes of this Tuesday first 30 minutes. So in the first we have cart low here, cart low of 973. So this is the cart low. And we also have the delta on the second candle, 1030, which is this one. And we also have delta of 2330, which is 2.33K. And we also have delta of 2490 here, 580. And here, good number, some 88 sellers are there. So if we calculate all this, so add all this and subtract this 88, since these are sellers, we get the 7315, which has been rounded as 7.31 by the system. So this is the calculation here, and we'll go into cart high. So here the cart high is 180. So in the same fashion, we'll come. So this is the highest point in 30 minutes, right? So let's see. Here I have taken 5 minutes. So this is where the highest point is there. So this high is very little higher than this point, previous high. So this is the highest point, and this is where the prices have closed. So look at it. So this is the highest cart high, 268 here, and what we do here, we have a delta of 88, minus 88, means sellers are there. Since we are calculating the cart high here, this is the high, and from this high point to where the current prices have closed, we are minusing this 88 delta from the previous number, right? 268 cart high. So now we get 180, which is exactly the number of cart high in this 30 minutes. So now 474 cart high is there here. If you want to get this 474 number, you need to divide this into 1 minute chart. So you go to the 930 chart where the candle opens, and you calculate. You take the cart high of the first 930 minute and you plus it continuously, plus or minus based on how much delta is there, and you will get the same number. How much? This one, whatever it is, 474 to be exact. So you will get the number. So on and so forth, the candle goes on, right? as the prices are going higher highs, the prices get calculated. So let's say suppose the prices starts coming down, coming down, coming down like this. So what will be the cart low again? The cart low will be, it will be resetted from here. So let's say here the 5-minute candle ends, and from this point, so since the prices are going down, generally the cart low will be negative. So in a bullish trend, the cart high, the cart low has to be as positive as possible. That tells us that there are enough number of buyers who are pushing the prices upwards, and the cart high has to be generally negative. Generally negative. Sometimes it will be positive also. So as the prices are making lower lows, the cart high has to be negative as high as possible. That tells us the total number of traders committed from high point to the in pushing the prices downwards to the current price. We will come to know. So the cart low has to be, as the prices is going up, it has to be generally positive. But this is with the cart high, cart low. It's better not to trade totally depend on this. So include along with this cart low and the cart high, COT, other the delta. So of course delta itself tells a cart low and the delta. It's more or less you can see either of one. So one is more than enough. So if you can include imbalances or some unfinished businesses or something like that, delta divergence along with this cart low and cart high, your probability of being successful in the trade increases. Now we are going to discuss. So far we have discussed the cart high, cart low. Now we are going to discuss about liquidity zones, volume clusters, and imbalances. So this is again a simple subject. So liquidity zones. What is liquidity zones basically? Whenever the previous buyer and sellers are trying to take control previously. So here what is liquidity zones in this bank nifty? So let's see. This is the liquidity zone. Look at this. Where the previous sellers are attempting to try to take control in this case. So what happened here? Look at this. Here previously the seller appeared here, right? At the same point, seller appeared here. So I mean passive seller, limit seller appeared here. So obviously this is a buy order. A strong buy order has come in, but immediately that supply is being supplied by much stronger seller. The buyer might have exhausted whatever the buying capacity he have. So the prices closed below the COT, and then the prices started going down. So this we can call it as a liquidity zone. This is where the people are coming in. Same way, volume cluster. So let's see. For tomorrow, if I have to say where the volume clusters are there, look at this. So this is where at the high, people are trying to take control. So suppose if the prices closes above the liquidity zone, where the maximum amount of volumes have come, there is a high chance the prices will make higher highs. Volume clusters and liquidity zones are more or less the same, nothing else. So look at this. So what happened? The prices have closed above these volume clusters. So tomorrow also, when the market opens on Tuesday, this area, this is where the volume clusters and the buyers have came in and prices closed above the volume clusters. So they will again try to take control. So what should sellers do in that case? They have to sell more quantity than these buyers' ability. So if these people sell more quantity, these buyers, whoever have controlled on this candle, they might fail. When the price is coming down, if the sellers are less powerful than the buyers here, then the prices again goes up. So you need to observe this area very carefully. So this is volume and in liquidity zones. Both are interchangeable in effect. Now we are going into imbalances. Let's understand what is imbalance. So imbalance is nothing but the difference between buyer and seller. So what does it mean? So here we are coming. In imbalances, we look diagonally from left to top, a step above, right? Not like this, but in this way, from left downside to one step up. So that's how the orders gets executed in the live market. So one step down to up, or from one step up to one step down. So here what we do, look at 9. So if you look at here 975.27, there is a imbalance. 59,393, there is an imbalance. 74,843, 1.1.5, 1.1, 1.5, 2K, 1.5. So at any given point of time, there will be definitely imbalance. But what matters is what is the ratio of this imbalance. That is what matters when you are trading. So here my settings is, let's say, 400%. So this 27 is lesser than 975. So the prices showed a imbalance. The candle showed a imbalance. 59,393. So again, this is more than 400% than the seller. So it showed a imbalance. 74,843. So here it has not shown imbalance, orange color, because this is less than 400%. How do you trade this again? Whenever, remember, whenever there is a imbalance in candle. So in a uptrend, if you are looking, so the candle has to close above the imbalance like this. Close above the imbalance. So here remember two rules. First rule is whenever you see this imbalance, higher the ratio, stronger is the buying power. Higher is the ratio, stronger is the buying power, but again lesser will be your entry exit opportunity. And one more thing is more imbalances, strong buying. More imbalances, strong buying is there. So you need to apply caution here whenever you see stacked imbalances like this, multiple things. So more imbalances are there. It's called as stacked imbalances. But you need to apply caution. Why? Here it only happens on dumping. Look at the range, how much range it has expanded. Almost 370 points in 30 minutes, which is very high, indicating maybe sellers are dumping everything, whatever they have in the single candle. So you need to be very cautious whenever you see high range with too many imbalances. With the low range, 2 to 3 stacked imbalances, that's okay. Here also stacked imbalances, the prices are closed above, which means the prices will go up. So basically in a downtrend, whenever you see a red candle closing below the imbalance, so left side you will see on a red candle if the price is closing going down. On a bullish candle, you will only see on the right side, and the prices has to close above the imbalance. So that's a very good sign that the prices might go. Now we are going into unfinished business, finished business, single print. What is unfinished business? What is finished business? What is single print? So these are again a very beautiful concepts. Again, contextual based. What is unfinished business? To understand what is unfinished business, you need to understand finished business. So in a green candle, finished business will be here on the last corner, right, and left side top. In a green candle or whatever. So here if there is a zero here, so this just tells you that there is business has been finished there. It doesn't mean the prices won't come down there. Right? It doesn't mean that. If there is a zero print, we call it as the business has been finished. So same thing, if there is a zero here at the top left side, we call it as a finished business. Here 78 is there. Some unfinished business is there. 229 unfinished business. But whereas here in a green candle, look at finished business is there on the lower side, which indicates sellers have got excess finished business. Went up and then again came down 33, and then again when the price is going up, finished business. So look at here 195 is there. This is unfinished business. Zero finished business. Now what does this tell you? So here we are not just taking a trade just because there is an unfinished business. This unfinished business attracts prices. So when I say attracts prices, it has to be as high as possible. So if you look at 195, it's comparatively less, I would say. Here in unfinished business, the rule is higher the number, strong reliability will be. So here 195 is relatively less because the bank nifty lot size is 15. So the reliability will be very less. Here only few lots. So here unfinished finished business is there. Finished business is there. So where it is reliable? Here 569. 430. So these are reliable. So again, because there is unfinished business, you don't take the trade. So this becomes the target. So one of the target. Tomorrow, suppose the prices started making higher highs like this. So your targets will be this and this. It's not that just because there is an unfinished business, you will take the trade. Same thing here. 313 is a good amount. It's not a very strong. 312 is a good one. So when, let's say tomorrow, I mean when the market opens, the prices opens here and the price is coming down like this, you will go for this. That tells us there is some unfinished business. So what is single print? So single print is nothing but, so whenever the print is small in single digits, this is the single print. This is the single print. So finished business, single print, both are more or less same. It means that more or less same. So you only take the higher numbers, not the smaller numbers. Let's say 1000, 2000 is there here, unfinished business, 560, 78, 700, like that. Only take those things as reliable. So these 12 or 6 or small numbers, you don't take it as a unfinished. So again, you only trade when the price is going in that unfinished business direction. Don't take the trade just because there is an unfinished business. Stops hunting. You are a normal trader who trade with 3 lots, 4 lots, 5 lots, whatever. But an institutional trader, he trades in very huge quantity, hundreds, 200, 300, 500. So then he want to execute 500 quantity at a lesser price. Right? So let's say he want to sell some quantity. If he sells at this price, he is going to sell at very much lesser price and he want to buy at lower price. When he less at this, when he sells at this price, he is getting better bargain. Right? So whatever the difference is there here, he is going to get better bargain here. So what he does, he look at the levels, he tries to hunt the stocks. So take references. Whenever you want to look at stop loss hunting, take references like this. Take references like this. This is the previous day high. So what happened here? So this, there is a yesterday some passive seller who stopped the up move. So this becomes your liquidity zone, or if stop loss hunting has to happen, people will might have kept a stop losses just above this. The stop losses will be generally kept above the candles or below the candles. There is a inverted hammer or something. People keep just below this. Right? There is a Morobosu candle. The people keep below this. Sometimes it works. Sometimes it may not work. So always try to remember the levels which you are trading. So again, what happens in the stop loss hunting? In this stop loss hunting, the orders will be very much visible in the order book of big traders. So when it is visible, it becomes easier for the big traders. Here you look at this, where how the price is closing. So the moment there was a here huge amount of order with zeros on the opposite side, this we discussed that this is a finished business, and immediately when the prices started coming down, so on 5 minutes chart the price is not closing above. The stop loss hunting is a very subjective thing, so you can avoid this stop loss hunting. You can avoid the stop loss hunting by understanding the levels of previous day, previous high, or some other important highs, previous double tops, double bottoms, something like that. And then let's say there is a double top or triple top, right? So what happens automatically when the price comes, when the price next time comes here, automatically people keep stop losses here. It's a very well known because price is getting rejected exactly. So what happens? Institutional traders, they try to hit these stop losses because that is where the liquidity is there for them. The best bargain comes when the prices are executed at as less as possible for them. So they try to hit the stop losses. So how you can avoid this? So immediately don't take the trade. When I say don't take the trade means don't sell it. only sell when the prices makes previous low. When the price breaks previous lows, here you can sell, right, on 5 minutes or 3 minutes. Same thing in this case, the prices have returned here, turned down. So in this case, what you do on the next day, you have that day high reference. You don't take the trade immediately. Wait, prices are going up. It went up, it came down. Always there will be pullbacks of important references. So remember this. Keep this imprinted in your mind. Whenever you see at a day high or current day low, the prices will try to make some pullback on 3 minutes or 5 minutes. Without pullback, a straight uptrend or down move, they generally won't sustain for long time. Most of the time there will be pullback. So there is a pullback here, and then the prices went up. It has broken here. Prices made a clean close above the reference. Then the prices might go again like this. So here you can take it because the price is sustaining that level for 5 minutes or even more. So in this way, by waiting and trying to understand what is happening in that thing, you can 70-80% you can totally avoid your stop loss. You are eager to take the trade just because the prices went up here, you will lose most of the time. So always wait and watch how the price is going to react importantly, and then only take the trade when the previous high is broken, right? Previous high or previous low in a down. So in this case, where you will take the trade because the prices have come down, closed here. So somewhere around this level, you can take a trade. Why? There are multiple reasons. Look at this. Here also you can take just below this. Why you will take the trade here? Prices closed here, low, and there is a pullback. So it came down. So look at this. Previously in imbalances, we discussed the prices has to close below the imbalance. There is an imbalance here. And we also discussed if the price closes below the COT, it acts as a resistance, right? Prices closed here, and you can keep immediately your stop loss just above this. This is going to act as a strong resistance. So in very rare cases, maybe the stop loss also might get hit. So you need to keep on observe. So don't immediately go with huge volumes again. This is second point you need to remember. Whenever you got some signal, entry signal, don't go with huge orders. So only the previous low is broken, you will start with minimum quantity, and you maximum add some 25%. So let's say your total you can go for 4 lots. Initially you go with 2 lots. 2 lots should be better. And when the price is breaking the previous low, so you added 2 lots here. When the price is breaking previous low, you can add 2 lots, and then immediately you exit 2 lots somewhere around the lower lows. And then once the previous high is broken, so look at here again, some passive buyer is continuously buying here. It says that strong buying is there, and look at how the price is closing above the COT, right? And there is an imbalance. So once the previous high is broken, you exit the rest of it. So you have locked good amount of profit since you have entered 2 quantity here. So up to this point, you have continued from here once the previous low is broken. So this is how you manage the trade. So always follow the position sizing, trapped buyer, trapped sellers, iceberg orders. So these are all more or less it's the same concept. It has various names. This is nothing but trapped buyer, trapped seller. This is nothing but trapped buyer. Why trapped buyer? So someone placed a heavy buy order, trying to push the prices up. So suppose, understand it's me. I have 1 crore rupee which I can throw into buying. So this 2.9k I ordered with that 1 crore whatever is there. I don't have any other money. So I don't have any other money, and the seller who is more powerful. The seller have 2 crore amount. So he is selling, he had the capacity to sell more than that. So he is selling everything, whatever I am bringing. So immediately what happens? I will unwind the position on the opposites. Immediately. I don't keep stop losses because I'm an institutional trader. If I keep a stop loss, suppose I entered here, I am a buyer. If I keep a stop loss here, it's not going to work. I tried a breakout here. But seller is more powerful. He pushed the prices down. So if I keep a stop loss, my average exit point will be very low. So then generally when I tried a breakout, there should have been a follow-up buying that is not there, which is indicated by this zero price. So I was trapped here. So immediately I unwind. So what is iceberg order means? In order book, you don't see this 2.9k. So on order book limit side, when I'm buying, I'm looking at the order book, right? It won't be visible in the order book, but when the price is going, the price is getting executed. Price is getting executed continuously, but the order book is not showing that order. So why that is happening? That seller, whoever is selling, he is selling with algo in his own system. So it is automatically firing some sell orders as I am trying to buy. So that we call it as a iceberg order. So whatever we see on the top, it is not the reality. So you need to be continuously watching to understand all this. So this is with the iceberg order, guys. So again, let me tell you, order flow charts is a very powerful subject. You need to focus on this order flow chart for at least 6 months to 1 year minimum to become good at it. And you need to understand the bigger picture of the market. See, bigger picture means the main trend is up. Main trend, the prices is making continuously higher highs, higher lows on daily candle. But you got a sell order on downside. Now, what makes sense is it makes sense if you go for a buy order. It doesn't make sense if you go for a sell order because the bigger picture itself is making higher highs unless the previous day low is broken. It is still a uptrend. So always try to understand the bigger picture. Don't try to just because there is a sell signal or buy signal, don't go for entries. So this is with the total order flow chart, guys. If you have any queries, comment in the comment box. So I'll try to address as much as possible. So thank you, guys. Please subscribe to my channel. Have a nice day.